Hi everyone, I hope you're all doing well. As promised, I am going to do a couple of videos on the board real quick for you to work you through the problems in Chapter 4. We have now entered Chapter 4, and today and next class we will be doing Chapter 4. Chapter 4 is all about forecasting. And you might think, what does that even mean? It simply means we're going to project a couple things. We're literally going to look out into our future and kind of estimate. I know that in marketing classes and management classes, we've had you do estimated budgets and things like that. This is kind of the same thing. If you've read through the chapter really quickly, you'll see that that's all a pro forma income statement is and a pro forma balance sheet. That is pretty much all of the calculations in this chapter are just basically saying, okay, we think we're going to have a 20% increase in sales next year. And why do we do those things? Again, if you remember back to Accounting 101 and Accounting 202, we talked about different kinds of accounting. You have managerial, which of course your insiders to the company utilize to make good, sound decisions. Should we employ more folks to get our orders fulfilled? Should we lay people off because we don't have a lot of orders coming in? They're to make managerial decisions. Financial accounting, which is kind of what we're doing right now, is finance. So financial accounting is all about your income statement. What's happening with your money? If you are looking to expand your business and you need to go out, seek out a loan for something, and you need to bring in money, you need to show that you are going to have growth because you need to actually show that you are going to be able to pay off a loan and to cover those expenses. So what we do is project. Again, they are used for both, meaning your managerial accounting and your financial accounting. So pro formas are kind of an inside information as well. They're setting goals and things like that. But for the finance world, they're all about raising capital, raising money, having the ability to increase your job or increase your company's assets, and how you are going to be in a cash end or start for your particular period. So this first one is all about the cash growth. This first one is set up, and again, for those of you that maybe don't have a laptop, I have put this information, so in case you can't see the board really well, I have put all this information below the video so you can look at the numbers. I've also put the solution there so that you can see it very clearly. So, sorry, I hate to read, but I'm going to read real quick because you need the basics of this problem. So I've created this, and this is exactly like number 1 in your textbook. The same wording, everything. All I've done is change up the numbers a little bit. So it says, Tom Smith is very excited because sales for his game company are expected to double from $300,000 to $600,000 next year. Tom notes that net assets minus liabilities, will remain at 50% of sales. His firm will enjoy an 8% return on total sales. He will start the year with $100,000 in the bank, and he is bragging about the Lamborghini and luxury townhouse he will buy. Does his optimistic outlook for his cash position appear to be correct? Compute his likely cash balance or deficit for the end of the year. So this is all about whether he has cash flow at the end of the year or whether he is in a deficit, which means that he is a negative cash balance. Start with the beginning cash and subtract the asset buildup equal to 50% of the sales increase and add in profit. So again, what they're doing here is basically just looking at your cash position at the end of the year. Is it positive? Is it negative? And this is really easy to calculate because they gave us all this base information. You don't even need to determine the net assets. So I've picked out an easy question for you because this just basically takes a couple multiplications, a subtraction, and an addition. And it looks tough, but I promise you it's not. So if we take a look, it told us in this problem that he starts out with $100,000 beginning balance. we've completed 1/4 of the problem already. So we put $100,000 because that's what Tom starts out with. And again, I'm looking down here for my computer, sorry, so I can actually see the problem. So then when we have what we call asset buildup, it's a little bit, your textbook, I like your textbook, I really do. Your textbook doesn't do a good job covering this one very well, what asset buildup means. This literally means the change. It's talking about your assets, but we don't calculate it based on your assets. We calculate it based off of the change in your net sales. And they give you those pieces of information. They tell you in this problem that you start off with $300,000 of sales, and we are projecting or looking out to the future to make $600,000 in sales in the next period or whatever. So the difference between those two is what? 600 minus 300 equals 300. So it's 300,000. And it says right at the bottom of this problem, and let me pick up my computer real quickly. It says equal to 50% of the sales increase. So we know that our sales, what our sales is now, 300,000, what it's going to be, 600. We know that difference is 300,000. So 50% of that, so 50% of 300,000 will be $150,000. This is a subtraction, so I put it in my little quotations. This is a subtraction here. So it's 100,000 minus 150, but we're really not going to do any kind of totals here. How do we project our profit? Again, our profit, we're going off the new sales, and it does tell you that. So his firm will enjoy 8% return on total sales. So your 600,000 multiplied by the return they told you, which is 8%. So do a simple multiplication. 0.08 times 600,000 on your calculator should get you 48,000. This is profit, so it's money coming into your account, right? So this is a plus. So you had to do 2 multiplications. Now you're going to do a subtraction and an addition. If we take 100,000 in your calculator, subtract 150,000, add 48,000, should get you a deficit of $2,000. So the question, again, back to your my little problem here. The second one says, compute his likely cash balance. So we know that he is in the hole for $2,000 based on these projections. If he started out with 100,000, 150,000 loss, 48,000 gain, he should end up 2,000 negative. So the second part says, start with the beginning cash and subtract the asset, add in the profit. What we want to know is, does his optimistic outlook for his cash position appear to be correct? Is he going to go out and buy a Lamborghini and a townhouse with no cash? Probably not. So that's all you're going to answer that for. So the first answer is he is 2,000 in what we call a deficit. So that's the answer right there. And he is definitely not going to be going out and buying a Lamborghini based off his cash projections here. So again, this is problem 1. All I've done is swap out the names and the numbers here, but the problem and the actual setup of your problem is exactly the same. We start with a number, the beginning cash. We subtract what we call our asset buildup, which is literally the difference between your beginning sales and your end sales number, divided by whatever number they tell you. In this case, it's 50%, so it's half of it. Profit, they tell you a profit number, which is 8%. By your 600,000 sales in this, gives you a profit of 48,000. Take your beginning balance, subtract your asset buildup, add in your profit, and you will get either a positive number, which is a cash balance, or a deficit, which is a negative balance. That is how we solve for problem number 1. Thanks, guys. Let me know if you have any questions.